Let's turn now to markets because our next guest says while the Fed may move more slowly on rate cuts after that jobs report, making job growth a key measure for central bank action is misguided in general. Jeff Kleintop is here. He's the chief global investment strategist at Charles Schwab. Jeff, fascinating discussion that we were just having. What are the market implications of it?
Well, I think one of the things is we take a look at the bigger picture, regardless of what the jobs are doing in the near term, and they are notoriously revised. The PMI is a data point that I'm really focused on, and I was seeing better economic growth earlier this year. It's one of the reasons why European stocks on the more cyclical parts of the world outperformed in the third quarter, but that's not really following through right now. We've seen a pullback in new orders. The manufacturing sector is softening up, and so unless we see more of a cyclical impetus following along with these lower rates, I'm afraid we might be a little bit disappointed as we go through the earnings guidance season here. So I'm a little worried about the outlook for what we hear on the earnings front. I know we're focused on the economy, but it's really going to be earnings, I think, over the next couple of weeks that are going to be the key to stock markets.
But hasn't ISM been contracting for a couple of years now?
Oh, it has, certainly, but it looked like it had bottomed and started to pick back up again. When I take a look at what the PMI does, it generally lags moves by major central banks by 9 months. This has been remarkably consistent for many decades. And we're now at the point where we've got about 12 or 13 of the advanced economy central banks out of 18 now cutting rates. And that's usually the point at which you start to see it bottom and begin to move higher again. So we're in that period of 9 months where it starts to move up from, let's say, around 50 on the global PMI to 55. That's usually a very good period for stocks. Earnings revisions move higher. Stocks have double-digit returns. Just not quite at that point yet. And I think the jury's out as to whether we see that follow through.
So that's interesting. For you, the number one most important data point the next couple of months is to see that ISM manufacturing out on the first day of the month start to move up towards 55 in the U.S. Does that make you not want exposure to industrials, to cyclical stocks, to all the rest of it until you get that confirmation and follow through, and even for the market more broadly?
I think it's okay to begin to build those positions now because the valuations are pricing in that it won't move higher above 50. And so I think there's some opportunity there. We really like financials. It's our number one performing sector, we think, as we look out. Outside the U.S., financials was the best performing sector in the third quarter. And I think they're starting to sense that maybe there's some real value there as maybe this upturn comes into play. So I think there's relatively less downside and more upside if we do see that follow through in the PMI.
You're also in the camp that thinks the election might not be a major event, especially if there's something close to divided government. Curious real quickly for your thoughts on the U.S. relative to Europe, which did outperform last quarter, and to China.
Yeah, so there's a lot going on, and obviously politics do have a bit of a factor. Tonight, actually, with regard to China, we're going to get an update from some of the policymakers tonight, about 30 minutes after the stock market opens in China, and we'll see if they deliver. Most important is to see if they raise that special bond issuance quota. If they do, there could be even more follow-through in China's markets. If they don't, and they're still vague about the follow-through on those announcements, we could give back some of this 40% gain we've seen in Chinese equities over the last month.
40% gain in a month. I think I read that it went from a 52-week low to a 52-week high in the span of 5 days or something like that. So Amazing. You're skeptical unless we get a bit of follow through in terms of data on the government bond issuance, local government bond issuance. What would you do with emerging markets and with Europe?
So I would favor Europe over emerging markets because we've had this powerful China rally. I think if we start to see this follow through in China, we actually start to see some of the luxury product makers in Europe begin to perform well. All of those names that really suffered earlier this year could really start to see a turnaround, fairly low valuations.
All right. So are you among the strategies? As we've seen, Goldman raise their year-end price target from 6,000 to 6,300. Others have been doing similar, but you are saying to people, don't be so sure until you get confirmation from those ISMs.
I am. That's my desert island piece of data. If I'm on a desert island going to get one economic statistic, that's the one I want to see. If I start to see that move higher, as it should, as it tracks lower interest rates, that should be good news. And, at the moment, we're seeing European companies' earnings outgrow those of the S&P 500 in the third quarter. We can see that again in the fourth quarter if that PMI around the world begins to move up. That's the key.
All right, Jeff, thanks for joining us. We appreciate your time today.
Thanks for having me.
Jeff Kleintop.